A few months ago, the story was simple. Rates were coming down, you just had to wait. That story is gone. The people who actually set the rate just revised their own forecast upward. 9 of the 19 of them now think the next move could be a hike. Not a cut, a hike. So the useful question stops being when do rates finally fall? It becomes this: what do you do with your money while they stay high? Here are 5 moves. Not one of them requires you to predict anything. If calm, plain English money breakdowns are your thing, take a second and subscribe. No hype here, just the math. Let's be precise about where we actually are, because the numbers matter more than the narrative. As of this recording, the federal funds rate sits at 3.5 to 3.75%. In June, the committee voted to leave it exactly there, and the vote was unanimous. Inflation is still running above their 2% goal, and that is the entire reason the cuts keep not arriving. Then they published their own projections, and that is the part that got missed. Their median forecast for where rates finish this year went up, not down. 9 of 19 policymakers now pencil in a rate increase before the year is out. Now, I want to be careful here because forecasts are not promises. That same group expected something quite different 6 months ago. And that is exactly the point. If the people with the models, the data, and the actual votes keep changing their minds, then any plan that depends on guessing their next move is not a plan. It is a bet. So let's build the thing that does not need the guess. Here's the reframe that makes the rest of this easy. High rates are not weather to wait out. They are a price, and a price always has 2 sides. When rates are high, your cash is worth more, and your debt costs more. Both of those are true at the same time today in your accounts. Waiting does not pause either one. It just means the good side is not working for you, while the bad side quietly is. 5 moves. Move 1. Put your cash where the rate actually shows up. This is the easiest money on this list, and most people leave it on the table. According to the FDIC, the average savings account in this country paid about 0.38% this June. Meanwhile, the most competitive, nationally available accounts have been paying north of 4%. Same dollars, same federal deposit insurance, same ability to get to your money on a Tuesday. Put $10,000 in the average account for a year, and you earn about $38. Put that same $10,000 somewhere paying around 4.2%, and you earn roughly $420. That is nearly $400 a year for filling out one form, one time. Nobody's going to walk over and hand that to you. You have to go and get it. I am not going to name a bank here, and you should be a little suspicious of anyone who does without telling you why. Rates move. The leaderboard changes constantly. Just compare a few nationally available, federally insured accounts, read the minimum balance rules, and move the money. Move 2. Kill the variable rate debt, because that same lever is pointed at you. If 4% on your savings sounds good, look at the mirror image. The average credit card interest rate is running somewhere between roughly 20 and 24%. Right now, depending on whose data you read. And those rates are variable, they ride along with the Fed. So rates staying high does not only mean a better savings account, it means a card balance compounding against you at punishing speed every single month with no rate cut riding in to rescue it. Here's the math nobody enjoys. Say you have $5,000 on a card at 22% and $10,000 sitting in savings at 4.2. You are not earning money. You are paying about $1,100 a year in interest in order to earn about $420. That is a losing trade, and it runs automatically in the background, whether you look at it or not. So once your emergency cushion is genuinely in place, paying that card down is not spending your savings. It is the closest thing to a guaranteed return you will ever be offered. And it is not close. If this is landing, subscribe so the next one finds its way to you. Move 3. For money that has a date on it, consider locking the rate. Not every dollar is the same dollar. Money you might need this month belongs somewhere you can reach instantly. But money with a known date attached, a tax bill in April, a roof in 18 months, a car in 2 years, can do better than a checking account. Right now, competitive certificates of deposit have been landing around 4% for short and medium terms. The trade you are making is simple and worth saying out loud. You give up access for a fixed window, and in exchange, the rate is locked, so it cannot drift down underneath you. And here is the honest nuance. Savings rates have already been drifting slightly lower, even while the Fed holds steady. So locking is not a prediction that rates will fall. It is insurance against the possibility. If you want to keep some flexibility, a ladder does both. Split the money across several certificates that mature at different times, so a piece of it comes due regularly. You get some of the locked rate and some of the access. Move 4. Stop waiting for the mortgage rate that is not coming. This one is the most expensive habit on the list. The average 30-year fixed mortgage is sitting near 6.55%, which, as of this recording, is the highest it has been in almost a year. Not the lowest, the highest. Rates went up while everyone was waiting for them to come down. If you have been sitting out of the housing conversation entirely, waiting for a number that keeps not arriving, understand that the waiting itself has a cost. Rent goes up, life moves. And nobody rings a bell at the bottom. To be clear, I'm not telling you to buy a house. That is not a decision anyone should make from a video. What I am saying is this: make the decision on the payment you can actually afford at today's rate, on today's numbers, with your real income. Not on a rate you are hoping shows up. If the payment works today, then the forecast is not the deciding factor. And if it does not work today, then the honest answer is not yet. And that is a perfectly good answer. A rate you can refinance later. A payment you cannot afford, you cannot. Move 5. Do not let the Fed rewrite your long-term plan. This is the quiet one, and it might be the most valuable. When rates stay high and the headlines get loud, there is a powerful pull to do something dramatic with your long-term money. Pause the retirement contributions. Sit in cash until things are clearer. Wait for the all clear. But look at what we opened with. In about 6 months, the official expectation went from cuts are on the way to 9 of 19 policymakers expecting a hike. If the committee that actually sets the rate cannot forecast the rate, the honest conclusion is not that you need a better forecast. It is that your plan should not require one. 4% on cash is genuinely good, and it is doing real work for your short-term money. But it is not a reason to stop the long-term machine. Keep the automatic contributions running. Keep the time in the market that you have already paid for. The whole advantage of a boring automatic plan is that it does not care what gets decided on the 29th of any given month. So let's bring it home. The Fed is holding, inflation is still above target, and the people who set the rate just move their own forecast up rather than down. So stop waiting and use the rates you actually have. Move your cash to an account that pays what the market is paying, because 0.38% versus 4% on $10,000 is about $400 a year you are leaving behind. Attack the variable rate debt, because it is the same lever aimed at you, and it is aimed a lot harder. Lock a rate for money that has a date on it, and ladder it if you want to keep some access. Make your housing decision on today's payment, not on a forecast. And leave the long-term plan alone. Not one of those 5 requires you to know what happens next. That is the entire point. If that cleared up the fog a little, subscribe. Next time, we are walking through the 2026 tax changes in plain English, because several of them are already in effect, and they quietly change what you owe. And the usual reminder before you go: this is general education, not financial advice. Every rate in this video was accurate when it was recorded, and it will drift after. Your situation is your own, so check your real numbers and talk to a qualified professional about what is right for you.